Good afternoon, and welcome to the NAI Pfefferly Annual Commercial Real Estate Forecast event. My name is Amy Pfefferly-Olhafen, President of Pfefferly Companies. 2021 was a challenging year in many ways. The biggest one was the loss of my brother, Mike. Mike was the president of our company for almost 10 years and played an integral role in so many of our successes. Mike was an incredible leader, not only in our company, but in our community as well. He also was the best son, father, and husband and friend to many. We will continue to honor Mike's legacy in our work and our strong customer focus. Despite the unfortunate circumstances, I'm excited to step into the role of president of Pfefferly Companies. As some of you saw, last year was a big year as we celebrated our 50 years in business. Today at Pfefferly Companies, we have 4 offices, 120 employees, 22 brokers, and over 500 commercial real estate listings throughout the state of Wisconsin. We also manage almost 13 million square feet of commercial office space. We had another record-breaking year in terms of transaction volume and number of transactions. A few changes to our brokerage staff. We added a commercial broker in the Door County region to our team, expanding our market coverage even further. Following Rick Knight's retirement, who was with our company for over 24 years, we hired Joe Schuessler, our new in-house corporate attorney, which is a huge asset not only to our team, but to our clients we serve. We also continue to believe in the importance of giving back to the communities that we serve. We're more involved than ever on volunteer roles, several boards and committees throughout the state. We are so thankful for our employees and clients for your continued support, not only over the past couple of years, but over the past 50. We look forward to continuing to work with you. Please don't hesitate to reach out if there's a better way we can serve. I hope you enjoy the presentation, and thank you.
With things starting to stabilize as we're coming out of the post-COVID last 2 years, and certainly the biggest black swan we've ever seen from a health and certainly a business point of view, was COVID-19. That is something that, unlike other black swans, it affected everybody. It affected businesses, it affected homes, it affected health. It was worldwide. It pretty much was a pretty big dent into our overall, experience, both from a business point of view, from a local point of view, from a global point of view. Business did recover much better than anyone thought it would coming out of COVID. The first year was a little dreadful, but then things really bounced back very quickly. There's still some challenges to be looked at going forward. Certainly the virus is still there. So I think we're going to see pop-ups in different aspects where people, fortunately, not as many people will be hospitalized or people will be getting sick, but they will still pick up the virus, which will cause some shutdowns, not mandated shutdowns, but more voluntary shutdowns as we go forward. And also from a commercial real estate point of view, coming out of COVID really accelerated what we would call the Amazon effect or the delivery effect. So certainly warehouses and retailing switching into delivery became a huge thing, especially in urban areas, but pretty much everywhere. Certainly as we are all witnessing on the television pretty much daily or on the internet or social media, another, pretty big black swan, the geopolitical, event in Russia and the Ukraine and certainly in Belarus and that part of the world was not expected. We knew there was always conflict there, but we were not expecting, a invasion and a war and then all of the economic aspects of that. So certainly this is having an effect both absolutely in the Ukraine and absolutely in Europe, with the different sanctions that are being made. And it is also having an effect in the United States. So, we're seeing obviously much higher gas prices. We're seeing much more inflation. And all of these things will have effects on the economy, and it will also have an effect on commercial real estate and a lot of uncertainty. We also have interest rates rising, and I think the US and certainly the Midwest will be a little better than, let's say, Europe, by example, and certainly some of the large cities, like New York and Chicago and San Francisco, maybe Atlanta. In office space will have a harder time recovering as quickly. But certainly, we are all praying that this will settle and it will actually, get more of a compromise or a ceasefire, or Russia will pull out and things could get back to normal. But I think for the near term, it will have a great effect for obviously over there and have some effect here in the US. Some of the major trends to look out for as we go forward in the year, certainly we will have, as I just mentioned, higher inflation. We'll have higher gas prices. We will have rising interest rates. All of those will have an effect on commercial real estate and real estate in general and the economy. And that will be everywhere. Unfortunately, that will be in Wisconsin. That will be everywhere in the United States. And certainly there's some changes coming along with the proposed changes to 1031 tax-free exchange coming out of the Congress that I don't think they'll be passed this year, but certainly it could be passed this year and go into effect next year. That could be a positive. That could certainly be a negative. The positive could be there could be a whole bunch of people that want to sell their properties this year to be able to take advantage of the 1031 tax-free exchanges. So that's certainly a trend. And then I would say one of the things that we have to watch as a trend is the whole back to the office. Certainly office space is generally designed for people that could work at home. And so at some level, it'll be interesting to see, how many companies will require people to come back to work, how many companies will shift to a work at home environment. Keep in mind, for the last 2 years, quite a few companies have shifted to a work at home environment and they've had record profits. So those are the two major trends that I would say coming into this year that we should be looking at. Even with the level of uncertainty that's going on that I've discussed, and certainly that you're feeling out there, commercial real estate is really, really doing quite well. And that's pretty much everywhere in the United States. Deal flow is very steady. Office space, as we discussed, is changing, but it's certainly not dead. And certainly we're seeing technology companies and other companies taking advantage of market situations to, gobble office space for the future. I've been in the real estate business way too long, close to 40 years, and nothing lasts forever. So things will change. Office will come back. It will be something that will be a product type that will be a good investment. And maybe now's the time to look into leasing new space because the prices are a little lower in office, or buying some office buildings that are good properties. Industrial is hot, hot, hot. That will continue to be hot as we have the continued demand for warehouses, data centers, and certainly logistics that go along with moving goods and services. So that will continue. And multifamily, of course, is extremely hot right now. And that's due to, essentially the housing market that's really tight with increasing prices. So a lot of people that would like to buy a house, unfortunately, can't buy a house. And so they will continue to lease, apartments. Retail is coming back. And, at some level, there are people that still go shopping. Keep in mind, internet is still only about 15, maybe 16% of the overall retail spend. And many firms, including NAI Federally and many other NAI firms, are having record years. So even though we have some situations out there that cause some pause, I'm very optimistic about the coming year, and I'd say the coming few years. And I think it's going to be wonderful for our economy and wonderful for commercial real estate. Thank you very much.
Hi, thanks for joining us today. My name is Liz Potasek. I'm a Senior Director of Market Analytics for the CoStar Group, and I'm going to cover the national property markets, talking a bit about recent trends and also what we expect going forward. It's tempting to assume that the pandemic is behind us. After all, we can now fly mask-free, but it's still the most significant factor impacting our lives, our economy, and our property markets. Now, when it comes to real estate, the trends that have gained prominence amid the pandemic are for the most part not new. but COVID played a significant role in shaping them. In some cases, trends accelerated and strengthened. In other cases, trends slowed and even reversed. But the pandemic was directly and indirectly involved in nearly all the changes. I'm going to start with the sector that not only faced a significant disruption initially, but faces the greatest long-term impacts related to the pandemic. Work from home or remote work is nothing new, but with the pandemic, firms were forced to adopt it wholesale and immediately. And this rapid expansion of remote work models upended the historical relationship between job growth and demand for space. Office using employment in many cases held up well, but tenants wasted no time shedding space. The impacts were far worse in certain markets. So the densest, least affordable, largest markets experienced an outsized impact. Exposure to tech was another factor, boosting both direct and indirect availabilities, as tech companies were at the forefront in adopting remote workplace models. Now, many firms are choosing to shed space ahead of lease expirations, and sublease availability has continued to move higher. In fact, in the first quarter, we hit a new high, 208 million square feet of sublease space on the market. And a large share of the space, 46%, is available but occupied, which means that firms are still in the space, they're still paying rent on the space, but they're marketing it for sublease. And if this space is still deemed to be excess at the end of the lease term, it is likely to be vacated, which will move market vacancy up and property cash flows down. So recent trends in leasing provide reason for optimism, although it's still best to view it through a cautious lens. Over the past 3 quarters, we've averaged more than 100 million square feet of leasing activity, which is in line with longer term averages. Now, some of this could reflect pent-up demand. So early on, office tenants avoided making big real estate decisions in the initial months of the pandemic, but lease expirations are now forcing their hands. So we'll see if this is extended. And with more and more firms returning to the office, we could see more notable acceleration in coming quarters. So there are still many factors, including the wealth of available but occupied sublease space, that could lead trends to reverse. For now, demand appears to be firmly back in the black. So we've seen 3 consecutive quarters of positive net absorption. And the conversation has shifted from firms stating that they were going to stay remote indefinitely to firms stating that they were headed back to the office in some capacity. Of course, many are still committed to flexibility, and we don't yet know how the hybrid model will impact demand for space. But still, good news that firms are now headed back. So we're not expecting further softening on a national basis, but we're also not expecting much of a recovery. And a lot of that has to do with development activity. We're down from peak levels, but still 140 million square feet of space is under construction, and it's highly concentrated. So 70% in just the top 10 markets. 35% of that space is spec, which represents 50 million square feet of unoccupied new space that will hit the market in coming years. So of all the sectors, retail faced the most significant disruption initially due to the lockdown and extended period of social distancing. And this led to a surge in closures, almost entirely among retailers that were already troubled. So the pandemic caused an accelerated shakedown of the sector. Once these underperforming stores closed and retail sales recovered quickly after the lockdown, the broader sector turned the corner rapidly, as you can see here. This chart also does a great job capturing recent trends in the sector. You can see that distress was an issue even before the pandemic, but the measures taken to contain the virus were the final straw for many retailers and led to a surge in bankruptcies in 2020. The retailers left standing were relatively healthy, and with those steady gains in retail sales, balance sheets across the board healed quickly. And this is reflected in a sharp decline in both bankruptcies and store closures in 2021 and year to date. The impact on leasing initially was notable, but it was also short-lived. And by early 2021, activity was back to normal. And this is despite a steady and consistent decline in average lease sizes as retailers move towards smaller and more efficient footprints. This year, in fact, we saw the strongest first quarter on record, 60 million square feet leased, and additional volume likely as researchers identify and enter deals signed by the end of March. Activity continues to be driven by discounters. So top lessees include Dollar Tree, Dollar General, Big Lots, Five Below, also off-price apparel. So Ross stores, Burlington, home stores are getting in on the action. Floor and Decor and At Home are active lessees. So we could see the market tighten further. And that's due in part to a very modest level of development activity. Just 52 million square feet of space is underway, which is a 10-year low, and 75% is pre-leased. It's overwhelmingly made up of build-to-suit, single-tenant, freestanding retail properties. Now, even as the overall market strengthens further, the disparity between the best performing assets and the weakest is likely to grow. In fact, there's significant bifurcation lurking beneath the surface across the retail sector. Retailers are focusing their expansion plans on fast-growing metros in the South and West while avoiding slow-growth Midwest and Northeast metros. And within metros, retailers continue to shutter in secondary and tertiary retail corridors in favor of busier, better locations. And with store footprints continuing to shrink, obsolescence is a growing problem. So even Target, Macy's, Burlington, Ulta, they're focusing growth on leaner, smaller footprints. So larger boxes in less trafficked corridors will struggle to find tenants. And enclosed malls in these types of locations will face similar issues as both anchors and inline tenants vacate in favor of smaller freestanding or simply better centers. Now I'm moving to the two sectors that have seen demand surge and in many ways have benefited from the pandemic. Now, many of the factors supporting demand for apartments were there pre-crisis. People were living more transiently, settling down later, waiting longer to have kids. Over the past several decades, there's been a notable change in the dominant household type. It's no longer married with children, but singles and married without kids. And singles have the highest propensity to rent. 50% of apartment units are occupied by singles. Now, several factors then emerged amid the pandemic. Through the lockdown and extended period of social distancing, people accumulated savings. So after living with parents and roommates, many had both means and likely the motivation to form new households. Some of these new households purchased homes, but many more rented apartments. The lockdown and economic dislocation also created pent-up demand. In the initial months of the pandemic, household formation dropped. Recent college grads provide a good example. With hiring on pause and the health situation highly unstable, they initially moved in with mom and dad. Then as the health situation and job market improved, the pent-up demand was released. The expanded adoption of remote work and rapid tightening of the labor market also is supporting demand by reinforcing a desire for flexibility. Households don't want to be tied down by a mortgage. We also likely saw some double counting. For example, households with a condo in New York City chose to spend lockdown at a rental in Florida. So household formation and demand decoupled to a certain extent. The shortage of single-family housing is also playing a role. That shortage of housing is causing a sharp rise in prices and households are increasingly priced out of home ownership, which keeps them in the renter pool. Now demand is moderating. So in the first quarter, less than 60,000 units were absorbed, which is just a third of what we saw in the first quarter of 2021. Some of this moderation reflects the fact that pent-up demand has been satisfied, and also probably fewer households are being double counted. But it also reflects the fact that fewer units are available to lease. So as new units come online, demand should pick up a bit. There are still many factors supporting demand, including that strong labor market, subsequent surge in wage growth, and still limited single-family housing. The pipeline is significant and remains near peak levels, so almost 700,000 units underway. So demand will struggle to keep up even as it improves, and you can see that vacancy rises gradually through the forecast period. As with any forecast, there are upside and downside risks. Demand could come in above expectations, and trends in search activity suggest that this may be the case. So search activity is a great leading indicator for apartment demand. Before you move, you consider your options, scrolling through the communities advertised on apartments.com. And as you can see, search activity is trending well above prior year levels, in line with last year's record-setting levels. So this could suggest upside risk for demand going forward. And new supply could come in below expectations, especially as supply chain issues linger. Now, one of the more notable trends to emerge in the initial months of the pandemic was the reversal of the multi-year trend of urbanization. So renters left urban properties in droves, preferring the space, affordability, and social distance of the suburbs. Working from home sealed the deal. Why pay a location premium if offices and amenities are closed? So rents followed demand. And in downtown properties, rents declined steadily through 2020. And then toward the end of the year, lower rents and healthy concessions packages helped to bring renters back. And as the health situation stabilized, that demand for urban properties accelerated along with rent growth. You can see that now rent growth downtown has stabilized, which not only reflects a couple surges in COVID, so Delta and Omicron, but also the fact that development activity has been concentrated downtown. So those new units, new properties are competing with a lot of other properties to lease up. And finally, industrial. So trends in the industrial sector look a lot like multifamily, with demand surging last year, substantially outpacing new supply and sending vacancy sharply downward. The explanation for the surge in demand is fairly simple. So strong household balance sheets and pent-up demand fueled a spike in goods consumption, both online and in stores, as you can see here. And most of the goods are imported, which helps to explain the backlogs at our nation's ports. Ports are still processing more shipping containers than ever before. Now, once the goods hit the ports, they need to be transported across the country, sorted and stored in distribution centers before reaching the consumer. E-commerce, of course, is a factor. Just-in-time delivery expectations have added another boost, requiring even more trucks, drivers, and distribution space. So last year, we hit a record, 1.2 billion square feet of space leased, and a look at quarterly trends suggested that leasing may have peaked in the first half of the year. But as you can see, the pace accelerated again this year. And we could, in fact, see another record in the first quarter. Headwinds for the sector are growing. Now, there are still tailwinds, even as consumption slows. Supply chain issues have proven to be very sticky, and there are new factors playing a role. For example, the Russian invasion of Ukraine. There are now new lockdowns in China. All of this continues to support a need for resiliency, which contributes to stockpiling and need for warehouse space, and the nearshoring and reshoring of production. But inflation is probably the number one headwind, the number one downside risk for the industrial sector, causing spending, particularly on discretionary items and goods, causing that to slow markedly. And as that slows, leasing activity is also expected to slow. Also important to note that early this year, Amazon, America's largest industrial user, announced that it would be slowing growth in its distribution network. This not only impacts the industrial sector directly. Last year, Amazon alone represented 25% of total net absorption nationally, but also indirectly to the extent that other firms see what Amazon is doing and see that as a signal or a sign of what they should also be doing. Now, the capital markets, as you can see, all kinds of capital chasing commercial real estate. And the first quarter of this year suggests that it's not stopping anytime soon. So the first quarter was the strongest on record, almost $200 billion in just the first 3 months. I do think it's reasonable to assume that activity this year will fall short of last year's record. There's still all kinds of capital allocated to real estate, but the environment, particularly the macroeconomic environment, is now more challenging with Fed tightening, the prospect of demand destruction, and the flight of levered buyers that will all weigh on investment volumes going forward. You can see that multifamily and industrial have been favored, but in the first quarter of this year, activity was a bit more equally distributed across the property sectors. For the most part, it's sales of more secure income-producing assets that's driving activity. So in the office sector, that means well-leased trophy properties. In retail, it was the single-tenant net lease sector. In industrial, it's the modern distribution centers with long leases in place. Now, those same types of assets, those secure income-producing assets, the trophy assets, that's what has been driving pricing. But it has also been supported by a limited share of distress, very little distress in the market today. Of course, gains were concentrated in the multifamily and industrial sector. So last year, pricing was up 10% in each. In retail and office, prices were up about 3%. Now, the same factors that are expected to weigh on transaction activity, again, mostly macroeconomic factors, will weigh on pricing. So we're not expecting declines, but it is reasonable to assume some downside risk to the pricing forecasts. And finally, just to look at cap rates. So this, as you can see, shows a fairly stable forecast for cap rates. The hawkish Fed, the increasingly hawkish Fed, does threaten the forecast. But still, there are factors that will continue to support or keep downward pressure on cap rates. That weight of capital. So it's really the weight of capital that has been moving cap rates lower. Investors are willing to pay higher and higher in prices and accept lower returns because it's the only way to compete in the space and acquire assets. That weight of capital, even as investment slows, it's slowing from a very high level. So still all kinds of investment dollars that will be chasing real estate. And there's not a lot of data to support this, but in theory, real estate is a great inflation hedge. And that's because real estate cash flows typically move higher in an inflationary environment. Now, all this being said, the speed with which the Fed is tightening and the significant impact this is having on debt costs has changed the calculus for investors, particularly leveraged investors. And to the extent that leveraged investors are now out of the market, this will impact demand and it will impact pricing. And that's all I have for you today. Thanks for joining us.
Good afternoon. With the financial markets experiencing a profound level of change, This is a perfect time to talk about the outlook for the U.S. economy and especially the local economy in northern Wisconsin. My name is Mike Steppe. I'm the Chief Investment Officer at Nicolet National Bank. By way of background, I spend the majority of my time analyzing various municipal bonds and mortgage-backed investments for our bank portfolio. Years ago, I taught investment analysis at Marquette, so I'm used to interacting and talking about these investment ideas. And I'm really a student of financial markets. I used to tell the students the best way to make money in investments is to look at what trends are happening and try to capitalize on the dynamics that are changing, because that's where the profit opportunities are. And I think today that's what we want to do, is talk about what's changing and what's the impact of that change. Right now, we're experiencing a fundamental shift to higher interest rates. If you take a look at the 5-year Treasury note, 5-year maturities, those interest rates are now near the peak that we've seen over the last 10 years. Over the past 7.5 months, rates on a 5-year Treasury have gone from a yield of 0.78% to 2.89%. The rate has more than tripled. And I sort of see that in 2 stages. The first stage was between August of last year, the end of summer, until the end of February. And during that period, rates went up on a 5-year, as an example, almost 100 basis points, or 1%. The curve flattened during that time, with short rates going up more than longer maturity rates. So that's always interesting to see, are all rates, is the yield curve, the shape of the curve changing, or what's happening? So rates went up, the curve flattened. The second stage, which was from the end of February to current time, about 7 weeks, rates went up another 100 basis points, for about 1%. And this time, while rates went up, the curve went up on a parallel basis. So 2-year rates went up, 5-year rates went up, 10-year rates went up. And it's interesting because the pace of change is accelerating. It took 6 months to go up 1%. It then took 7 weeks to go up 1%. The key reason for this increase in interest rates is that inflationary pressures are intense. They're increasing. CPI for the last 12 months is up 8.5%. And we all know and experience it. If we go to Quick Trip, gas costs more. If we go to Festival Foods and buy steak, it's going up. If you're looking at housing prices or you're looking at apartment rents, prices are going up. So markets are expecting inflation to be higher. So if you go back even just 4 months ago, people were looking at inflation and thinking 4.5%. Now they're thinking between 6.5% and 7.5%. When you look at for next year inflation, still expectations around 3%. So when earlier this year, when the Fed was talking about inflationary pressures just being transitory, they're not. And we see that in sort of our day-to-day life. The immediate factors, the price of oil, food prices, the global supply chain issues that we're seeing, and higher interest rates are all causing prices to go up. So in addition to that, though, there's a set of fundamental factors, structural things that are happening that are also pushing prices up. Deglobalization is the biggest one. So we spent years trying to get things, global supply chains, where it was just-in-time inventory, and people would have this made in China and then assembled in Vietnam and then back to Taiwan for something. You had all these various supply chains that were very effective and brought costs down. Now, the trend that we're seeing is everybody is going to more local sourcing, and that raises the prices. It's not a bad thing. It's just the impact of it is that it raises prices. Second big thing is we're seeing decarbonization. Again, climate change, the issues there where people are focused more on using less fossil fuels, and that winds up with higher prices. We'll eventually get lower battery storage costs will wind up, but in the meantime, as we make this transition, there are higher prices. We all know, especially in this audience, higher housing costs. We see that daily. Wages are rising. So there's these structural factors, the deglobalization, the decarbonization, higher housing costs, wages. Those are things that are structural, that are going to be around for a while. So when you heard commentary about inflation being transitory, it's not. The Federal Reserve has seen these inflationary pressures, and it's trying to catch up. For a while, it was in that this is just transitory mode, and now it's in this idea, yeah, we're behind the curve, and we got to scramble to catch up. And so what we're seeing is a shift in policy. For the last 5 years, the Fed's been focused on quantitative easing. That's what we call this. Now, the mindset has changed to quantitative tightening. At least that's the wording people are using. And what that means is there's a number of policy steps that the Fed is taking to become less accommodative. They stopped purchasing treasury notes and mortgage-backed securities in the market. They had become the biggest buyer, 20% of all the treasury notes, a third of all the mortgage-backed securities. So they stopped doing their buying. They also initiated the process of raising overnight rates. So we've seen that last month they increased overnight rates by 25 basis points and started that process. Third, they're planning to decrease the size of their investment holdings. Again, they built up this massive portfolio of holdings, and so now we're going to see them try to decrease that size. The financial markets look at this, and they're anticipating 6 additional rate hikes this year, some 25 basis points, some 50 basis points, and probably several more hikes in early 2023. Whether all those will happen or not is yet to be seen, but for right now, that's what's being built into the market set of expectation, is that we'll see at each meeting this year, they've got 6 more meetings yet this year, we'll see a 25 basis point increase. So when the Fed makes these policy changes and they go from what we're calling quantitative easing to quantitative tightening, there are winners and losers. And if you think back to quantitative easing, so the Fed brought rates down. They did it on the short end by bringing rates down. On the long end, they did it by buying securities. So when they did that, there were clear winners. The winners were borrowers because they could borrow at a lower cost. Investors did really well in that kind of a period because the Fed was encouraging them to take risk, and there was the Fed was involved in the markets, and that was creating winners and losers. Those were clearly the winners. The losers in that time period were savers. So people that had depended, I always think of my parents' generation, CD savers, okay? Used to roll a 3-year laddered portfolio of bank CDs. And so those rates came down and they just weren't getting compensated with much in the way of interest. So they lost in this process. The Fed always likes to say they don't pick winners and losers, but their policies really do. You do see an impact, and there are clear winners and losers. When you look and you see this switch to quantitative tightening, you're going to see again a change. Savers are now going to earn more money. So that 3% CD will eventually get there. You're already seeing treasury notes move up substantially. So that's going to be a big difference. Borrowers are going to be the losers this time around. So you're going to see a situation where, in the past, you just think about the home mortgages that were written at 2 and 3% and long term. And now, those are clear winners from the quantitative easing. Now, quantitative tightening, that's not going to look very attractive. We see home mortgages at 5%. So that's going to be a change. And so we continue to see that, and borrowers will clearly pay more. With all these changes in the world, it's helpful to step back and look at the fundamentals and say, okay, what do we have a sense of confidence around? First of all, GDP growth is likely this year going to be in the 2.5% to 3%. When I'm walking through the halls of the bank, people stop me and say, "Are we in a recession?" It's no, we're not even close to a recession. GDP growth, 2.5% to 3%. Those are reasonably good numbers. I mean, on a historical basis, we used to run around 2%. So we're stronger than that. Secondly, we've got a white-hot labor market. Payrolls continue to grind higher. When you look at the job openings that are out there, you see a lot of activity there, a lot more people looking than in terms of looking to hire. And so we're seeing a noticeable increase there. So labor market's really strong. Third thing is corporate earnings are strong and growing. So companies are incredibly resilient. That's what we found through this whole pandemic, is that companies find a way, whatever the problems, whatever the challenges are, they do a good job of dealing with it. And what you see is that S&P 500 earnings, again, every time I pick up the paper, I see, the analysts are lowering the earnings expectation for this company. But the part that doesn't get a lot of coverage is the analysts raising it on 6 others. So every couple of weeks, if you look at the S&P 500, what the analysts are projecting for the index, you see it inching up. And so you generally don't see a recession when you have a period where you got a white-hot labor market and you have corporate earnings going up. And we're seeing both of those. So the immediate outlook is good on the overall economy front. The top question that I hear, again, is when is that recession going to hit? And we don't know. And we'll sort of see how this plays out. The two things that I watch, and I think others should watch, is when you're looking at it, the things to watch would be the yield curve, the shape of the yield curve. So generally it has a positive slope. The beginning of April, on April 1st, the curve inverted. And so what that meant was 2-year yields were higher than 10-year yields. Again, doesn't happen all that often, about historically 15-20% of the time. That's usually a sign that the Fed is expected to push rates up to a level that's higher than it'll probably tip the economy into a downturn. So you keep your eye on that. And if you see a prolonged period of short rates higher than long rates, there's probably some worries that would be associated with that. The second thing that I worry about is consumer sentiment. When you look at that, University of Michigan polls people about how they're feeling about the world. And what you're seeing right now is people are feeling down. It's a combination: COVID, higher prices, Russian invasion of Ukraine, all these things that people don't have a sense of control over. And so, in terms of that, you got to be aware of what that means for consumer spending. So got to keep an eye on that. But in general, things are good right now. And that carries over in the real estate markets across the board, whether it's a residential or, any type of commercial activity. So the backdrop is positive. The key points that I'm trying to make today, first of all, is that interest rates have shifted higher. That's a big deal. Inflationary pressures are more intense than people expected. That's why part of the reason why rates are higher. The Fed is reacting to that and shifting monetary policy. Higher rates are creating new winners and losers in the market. Want to be aware of that and what that's doing. The labor market is really strong, likely to stay strong for a period here. Businesses are highly resilient and finding ways to make more money. And that's been a great thing for the employment situation, a great thing for stock market. And the warning signs, the things to keep your eye on as we sort of watch how all this plays out. Again, what's happening with consumer spending? Are consumers have cash? Do they spend it? Are they feeling like this is an okay time to go ahead and spend money? Or are they starting to pull back? At this point, we've continued to see them spending money. It'll be interesting to watch with autos as the production ramps up and we get the chips and we can now have some cars on on the lot in terms of inventory, whether people step up and buy. We know there's some demand out there. It'll be interesting to see what that translates into. And lastly, the thing to keep an eye on is the yield curve. If the yield curves positively slope, we're probably going to continue to see some economic momentum. If the curve inverts, where short rates are higher than long rates, probably more issues to worry about on that front. So that's the backdrop for what we're experiencing, and I'd be happy to take questions. I love creating the dialogue, so I really look forward to the question and answer period. Thanks for having me. It's been great timing to do this. Perfect. Thank you.
Hello, thank you to our speakers for all the great information and perspectives. My name is Manny Vasquez, Vice President of Business Development at Pfefferly Companies. As you heard Amy Oldhaven say at the beginning of the program, NAI Pfefferly had another record year in 2021, closing more than 250 sale and lease transactions, almost 40 more deals than the previous year. So thank you to many of you on the call who rely on our team for your real estate needs. And a special thank you to our top-notch brokers and support staff across the state, many of whom you see right behind me. They work very hard, and I'm proud to be on their team. We now have a few minutes for Q&A, and joining us on screen are our speakers. Thank you again for your perspectives, everyone. Jay Olshansky with NAI Global, Liz Patasek with CoStar Group, and Mike Steppe with Nicolay National Bank. So let's dive right into a few questions. We have about 10 minutes or so we'll try to move quickly. Mike, we'll start with you. With the price, and this came via the chat, so thanks to those of you who submitted your questions. With the price of construction as high as it is, whether that's in residential or industrial, do you believe this will be our new floor, or will there be a correction like there was in 2008, 9, and 10?
I think we're in much better space today than we were in 2008, 2009, 2010. I think balance sheets are much better positioned than they were then. I think when you look at residential property, you saw a number of people after that 2008 to the 2008 to 2010 period, you saw a number of developers get washed out of the business. And so we're now, we get this ramp back up in activity, and there's less people, there's less houses structurally out there. And so there's this demand that's trying to find a place to live. And that makes it much more solid from a base perspective than what we've experienced in the past. Yeah, there's a cycle. We're going to continue to go through cycles, but I think the base feels better than it did then.
Thank you, Mike. Liz, we'll go over to you. You talked about the repurposing of vacant big box space. One of the challenges that we see locally are municipal zoning and use restrictions. Are you seeing the same trend in larger markets, or is it more of a small market dynamic?
No, I think you're going to find that in all kinds of markets. And unfortunately, it's not, you can't even look at, say, Cleveland and assume that, those types of zoning restrictions are consistent across the area. It's often the local municipalities. I see that as a challenge ongoing and across markets, big and small. Yeah.
What are some of the most creative uses that you've seen out there, since we're talking about vacant big box, putting you on the spot?
Right. So, I mean, as you all know, it's a big challenge, big, no pun intended, but, often if it's a vacant big box, it often speaks to a less favorable location. So if it's not a great retail location, it likely, you could raise it and put up multifamily, but is it a great multifamily spot? Industrial, you definitely run into some of the zoning challenges, and truck traffic. Can the transportation network, can it accommodate the truck traffic, that type of thing? And then office. Well, why would you want to put up office right now? So, how many trampoline parks can we have? I think self-storage has been a good redevelopment strategy. Strong demand for self-storage. It doesn't need to be in a great area, so that I think has been successful. Gosh, I mean, it's a short list, which is why there's so many big vacant boxes remaining.
Right. And then the cost also needs to make sense for developers to look at a project like that. So Thank you for that, Liz. We're definitely seeing some of those trends locally as well. Jay, over to you for kind of the national, global picture. Labor shortages are keeping our clients up at night, and our company itself, many others. Are other markets around the country seeing the same labor and workforce issues that we're seeing here in Wisconsin, where unemployment is below 3%?
Yes, is the fundamental answer. That unemployment is very low just about everywhere. But you also have to remember, you have to look at the type of jobs that in each of the micro markets or the individual markets. But overall, there's certainly a war on talent. I live in New York City. I've been told that if you're in the finance business and you're not a deadbeat, you can just change jobs right away and someone will pay you more money. I'm hearing it's impossible to find, restaurant workers in lots of places. I actually went to a restaurant recently in a southern state and couldn't get served. I had to wait 40 minutes to get served because they only had 6 servers in the restaurant. And this was dinner time. This was like Saturday night at dinner time. So it is everywhere. I don't think it's unique to one market over another market. One point that I wanted to make, which is just my own observation. Today I read that Sam Zell Equity Residential is going to sell their New York portfolio. It's about $750 million. And I also read yesterday that Blackstone is going to buy PS Business Park, which is basically an industrial and sometimes self-storage too. So in my mind, that says multifamily is peaking because Mr. Zell generally sells at the top, and industrial and self-storage still has a lot of runway to go because Blackstone doesn't usually buy if they think things are peaking. I always say to people, when Blackstone turns to be a net seller, then the market's going to change. So those are just an observation. I know it has nothing to do with labor, but it's something I read this morning and I thought, multifamily might be getting a little at the top.
Thanks for that, Jay. Good insights. We are almost at time. So Jay, Liz, and Mike, thanks again for joining us today. We really appreciate it. And thanks to all of you for attending. We had over 150 attendees this year, and we really appreciate your ongoing business and partnership. Later this week, we'll be sending all of you an email with links to market reports showing additional local data for all the major property segments that we talked about today. So look out for that email. And as always, please reach out if you have any questions or if our team can be of any help. So thanks again and have a great rest of your day.